Thank you for joining me today for our 2022 market outlook titled Passing the Baton. This is coming to you today from Steve Kuna of Retirement CFO, sharing insights from the LPL Research Department. Our resurgent economy grew at over a 6% pace in the first half of last year and ended up with over a 5% growth rate for all of 2021 by the time it drew to a close. The current economic recovery, which started in May of 2020, has benefited from the widespread vaccine availability and additional fiscal stimulus. And we've had a hand up that has helped us through a period of unique economic challenges. In 2022, the economy may be ready for a handoff, back to a greater emphasis on the individual choices of households and businesses. And how smoothly that handoff is executed may determine the course of the recovery. For those of you who don't know me, my name is Steve Kuna, and I'm the founder and managing partner of Retirement CFO. I'm a 28-year plus retirement-focused advisor. I'm a certified financial planner, wealth manager, retirement income planner. I've also done a ton of corporate retirement plan design and service work. I was named a top retirement plan advisor by Plan Advisor magazine and the Financial Times several years running. I'm also the host of the Retirement CFO channel on YouTube, and been featured on CNBC, Fox News, Wall Street Today, and a few other national news programs. So the U.S. economy bounced back from its worst year since the Great Depression. In 2020, with one of the best years of growth in nearly 40 years. In 2021, a combination of record stimulus, healthy consumer, an accommodative Fed, vaccinations, and reopening of businesses all contributed to the big year. In what amounted to be the shortest recession on record, only 2 months in March and April of 2020, the economy came roaring back to produce what is currently expected to be by the end of 2021 was more than a 5% GDP growth rate. And that's more than making up for the 3.4% drop in GDP in 2020. Of course, there have been hiccups along the way. You can't shut down a $20 trillion economy and then expect it to get going again without warming up first. So supply chain backlogs, materials and labor shortages, high prices all held the economy back to varying degrees. But the good news is demand is still very strong, and as the backlog unwinds, which could take years in some cases, we expect above trend economic growth and see low risk of a recession in 2022. With various measures of output matching or exceeding pre-pandemic levels, it's clear last year's recession is in the rearview mirror, and it may go down as the shortest one in history, even shorter than the 6-month recession from the early 1980s. As the U.S. economy moves more to mid-cycle, our 2022 forecast is for a 4 to a 4.5% GDP growth this year. While a slowdown from 2021, it's still a very solid number. We expect inflation to tame from 2021 levels a little above 3%, with core inflation numbers lower. And it's a step in the right direction, although it may still be on an upward trajectory the early part of the year. Globally, Europe, Japan were hit especially hard by the pandemic in 2021, but as COVID-19 cases potentially fall globally, those areas could ride out for better economic growth in 2022. Meanwhile, emerging market economies may disappoint as growth in China could be constrained by regulatory crackdowns. So as we all know, 2021 was the year nearly everything was in a shortage, and it all translated to added inflation pressures. Record numbers of ships waiting at ports, a lack of materials, unfilled job openings, higher commodity prices, a lack of truck drivers, major backlogs, and supply chain disruptions all added to the large price increases seen essentially across the board in 2021. Now, while we do believe these pressures will steadily decrease over the next year, and inflation will eventually settle back to the 2 to 2.5% range, it'll likely be a gradual process. Inflation remains near its historic run rate after removing the most volatile pandemic-influenced prices, but still supply chains may take a year or two to be fully addressed, and depending on the product and the scale of the problem. Despite challenges around supply chains, hiring, and prices, if the demand is there, it should help drive continued improvement as businesses adapt to address these challenges. That's likely to leave us with a positive economic backdrop for at least 2022 and maybe much longer despite current inflation levels. Prospects for above average economic growth and accompanying earnings gains in 2022 points to another potentially good year for stock investors. While the pandemic is not completely behind us and there are several other risks to watch, particularly inflation, stocks have historically done well in mid-cycle economies. We believe we've started or are already in the middle of an economic cycle with at least a few more years left. Historically, if this holds true, then we believe the chances of another good year for stocks are quite high. $5,000 would be a fantastic round number for investors to celebrate. The question is, will that celebration take place in 2022 or later? If we assume S&P 500 earnings growth improves to around its long-term average of 8% or about $235, while the price-to-earning ratio, or the PE, stays about where it is between 21 and 21.5, the S&P 500 could be fairly valued at $5,000 to $5,100 at the end of 2022. If interest rates stay lower for longer and support PE multiple expansion, stocks could potentially exceed this target by year-end 2022. But if profit margins face more intense pressure than anticipated, possibly from wages, earnings may have a hard time growing at all in 2022. Time will tell. In a mid-cycle economy, recession fears do not typically cause stocks to fall in a given year, nor do stocks typically surge as investors celebrate emerging from the prior recessions. Over the past 60 years, the S&P 500 index was up an average of 11.5% during the 30 mid-cycle years we identified, with gains in about 80% of those years. As you can see, stocks rose during most of these mid-cycle years, with 1966 and 1977 the only 2 years with double-digit losses. The Fed, which we initially expected to start raising rates in early 2023, seems to have moved up its timetable. Central banks typically begin to raise rates when the economy is exhibiting mid-cycle characteristics. That also characterizes 2022 as a likely mid-year or mid-cycle year. Historically, stocks have done very well leading up to the Fed's initial rate hikes, with gains in each of the past 9 instances of an average gain of 15%. So we expect stocks to follow this mid-year pattern and potentially deliver double-digit gains in 2022 as the economy continues to expand at a solid pace. An expanding economy is a great start, but stocks fundamentally derive their value from earnings. So stable profit margins and increasing share buybacks make double-digit earnings growth for the S&P 500 a possibility in 2022. However, COVID-19 related supply chain issues and materials and labor shortages could lead to an even higher cost this year, slightly or potentially weighing on profit margins. And as a result, we're forecasting a slightly below average S&P 500 earnings growth of 6% in 2022, or $218 in S&P 500 earnings per share. Also, higher corporate taxes could also potentially eat into some of those earning gains this year. For 2022, near-term inflation expectations above historical trends and improving growth expectations once the Delta variant recedes are reasons why we believe interest rates could move moderately higher from the current levels. In 2022, we expect the 10-year Treasury yield to end the year between 1.75% and 2%. However, an aging global demographic that needs income, higher global debt levels, and an ongoing bull market in equities, which potentially means more frequent rebalancing into fixed income, may keep interest rates from going much higher in 2022. While we don't expect interest rates to move much higher in 2022 because starting yields for core fixed income are still low by historical standards, returns are likely to be flat to the low single digits in 2022. It's not a great year, but we should see at least an improvement over the negative fixed income returns we saw in 2021. With long-term interest rates close to what we think will be cycle highs, it's important to revisit the case for fixed income or bonds within a broader asset allocation. Core bonds have historically provided capital preservation, portfolio diversification, and liquidity, which we think are important portfolio construction objectives and help clients remain committed to their investment goals. With the economy likely transitioning to a mid-cycle, the need for high-quality bonds increases in our view. Moreover, the need to offset potential equity market volatility remains an important role for core fixed income. Bonds, particularly core bonds, have been less volatile than stocks and have historically provided a ballast to portfolios during equity market drawdowns, which, as we know, are normal occurrences from time to time. The maximum drawdown for bonds in any given month has been dramatically less and less severe than stocks. While the worst drawdown in a month for equities was 28%, the worst bonds have done during a month was down 6%, and those losses were quickly reversed. So when combined with equities, bonds help reduce total portfolio volatility, which can make for a smoother investment experience for clients. So what's next for credit? And here we're referring to high-yield corporate credit. As the economy transitions into mid-cycle, credit investors need to be more cognizant of downside risks. While the economy should still be conducive to credit risk and corporate balance sheets generally remain in good shape, credit spreads are among the lowest they've been in years, which means compensation for the added risk of corporate debt is very low. So both investment-grade corporate credit spreads and high-yield credit spreads are in the bottom 5% compared to history, which means that valuations have been cheaper 95% of the time over the past 20 years. So corporate credit markets, both investment grade or high grade debt, as well as high yield or lower grade debt, are currently priced near perfection. So any unforeseen event, either related to the economy or the corporate level, could negatively impact credit markets. Our research department remains neutral on investment grade corporate debt, but we think equities continue to offer better upside return potential than high-yield bonds, where we remain underweighted. In our active portfolios, we have no exposure to high-yield bonds right now. For income-oriented investors willing to take on more risk, we think bank loans are still a better option for them. So to conclude, federal, state, and local governments, usually better suited for the role of timekeepers or race officials, have actually run a pretty strong leg for the economy over the last 2 years. No one would find this level of government involvement ideal under anything close to normal circumstances, even if it was necessary to some degree in the face of the pandemic. But the private economy was by no means on the sidelines while this was happening. While some service-based industries were devastated by the pandemic, businesses on the whole innovated, they adapted, and they evolved. They positioned themselves well to take the handoff and run the next leg, and our market views reflect that. We're watchful of the risks associated with government passing the baton in 2022, but we believe that ultimately the economy will be healthier while still managing to create opportunities for investors. So that concludes our market update for 2022. We'll be doing a mid-year update sometime around July or August, so stay tuned for that. Thanks for your attention, and always, if you need to reach us, you can reach us at RetirementCFO.com. Thanks a lot, and be well.